As the U.S. market is currently closed, we are looking at the final figures from yesterday's session. Transocean, ticker RIG, finished the day on October 23, 2025 at $3.89 a share. This wasn't just a quiet close, it was a massive spike, up nearly 14% on the day, capping off a trading session that saw the stock move in a wide range between $350 and $396. The volume was enormous, more than double its recent average, indicating significant conviction behind the move. Now, many investors see RIG as a simple story. The general belief, the broad expectation, is that this is just a leveraged bet on the price of crude oil. You see oil futures tick up, you check your Robinhood app or your SoFi Invest account, and you expect to see Transocean catching a bid. It's the go-to name for high beta exposure to the energy sector, a stock that many use for a quick trade, not a long-term investment. But if you believe yesterday's surge was just about the price of West Texas Intermediate, you missed the real story. The reality of this company and the forces moving its stock is far more complex than just a commodity price. Yesterday's move wasn't just sector momentum, it was driven by concrete company-specific news that forces a complete reevaluation of the narrative. A massive insider purchase and significant new drilling contracts. This changes the entire picture from a simple bet on oil to a high-stakes play on corporate survival and fleet positioning. Let's break down what actually happened. The market is pricing most high-debt companies, especially in capital-intensive sectors like offshore drilling, very nervously. This isn't a clean tech story like Nvidia stock or a consumer giant like Apple stock, where the market debates unit sales or AI chip dominance. This is a gritty, cyclical business. Transocean is sitting on a mountain of debt, a legacy from building its advanced fleet. For years, the expectation has been that this debt load would eventually sink the company, that it was in a race against time and interest rates. Many investors doing their self-investing looked at the balance sheet and ran for the hills. But the reality that hit the tape yesterday was a major insider buying millions of shares. This isn't a small token purchase. This is a significant signal from the inside that management believes the company is navigating its most difficult period and is severely undervalued. Simultaneously, the company updated its fleet status report, announcing new contracts and extensions for its ultra-deepwater drillships at very strong day rates. This adds to their already substantial backlog, which is the real metric of health for this company, providing revenue visibility that insulates them, to a degree, from the spot price of oil. This is the tension you must understand when looking at a stock like RIG. The expectation is that it's a weak company, drowning in debt, just hoping for an oil price bailout. The reality is that it operates the most technologically advanced fleet of ultra-deepwater rigs in the world, and those assets are in scorching demand. Oil and gas majors are willing to pay premium rates for these specific high-specification vessels, the ones capable of drilling in the most difficult environments. The market is slowly waking up that while Transocean has balance sheet problems, it has an asset advantage. This isn't a story you can understand by just looking at the charts on the Robinhood stock trading platform. You need to read the fleet reports and the bond indentures, things most retail traders and even some managers using Schwab Intelligent Portfolios might overlook. This is a complex situation, far removed from the passive online investing approach of just buying Fidelity ETFs. Yesterday's volume spike tells you the institutional players are taking notice. This wasn't just retail speculation, the kind you might see in Robinhood crypto markets. This was big money, moving through platforms like Interactive Brokers, taking a stand. When you see a stock like this, which is heavily shorted, pop on high volume with fundamental news, it forces a re-rating. The short sellers who were betting on bankruptcy are now feeling the pressure. Their expectation of a debt spiral failure is colliding with the reality of a strengthening contract backlog and supportive insiders. This creates a volatile, dynamic trading environment. This is why having a robust platform, whether it's the Fidelity mobile app or the professional-grade interactive brokers platform, is so important for actively managing this kind of position. You can't just set it and forget it in an intelligent portfolio. So, what does Transocean actually do? They are the world's largest offshore drilling contractor. They don't own the oil, they own the massive, technologically sophisticated drill ships and semi-submersible rigs that oil companies like Shell, Petrobras, and Equinor hire to drill wells in thousands of feet of water. Their business model is built on long-term contracts. A new rig can cost over $500 million, so rig needs to secure contracts that last for years to justify the expense. For the last decade, following the 2014 oil crash, the market was oversupplied with rigs, day rates plummeted, and companies like Transocean were forced to scrap dozens of older vessels and fight for survival, taking on debt to stay afloat. This is the history that informs the market's negative expectation. They see a company that has been in survival mode for 10 years. But that's the past. The reality is that so many old rigs were scrapped that there is now a shortage of the high-end rigs that Transocean specializes in. This is why they are suddenly able to command day rates that are multiples of what they were just a few years ago. This is where the analysis gets interesting for anyone building an individual brokerage account. You have to weigh two powerful opposing forces. On the one hand, you have the macro pressure of high interest rates. This is a huge risk for Transocean. It makes refinancing their existing debt far more expensive. This is a headwind that doesn't affect Tesla stock or other companies with stronger balance sheets in the same way. On the other hand, you have a tight market for their specific services, allowing them to generate significant free cash flow. The entire bull-bear debate on rig centers on one question: can they generate enough cash from these new high-rate contracts to pay down their debt and fix their balance sheet before their debt maturities hit? Yesterday's news suggests the answer is leaning toward yes. The new contracts provide cash flow, and the insider buy signals confidence. This is the kind of deep analysis that Fidelity Wealth Management clients pay for, understanding the specific, granular drivers of a business, not just the headline sentiment. For those of you managing your own investment help or using investing sites to find ideas, Transocean is a case study in contrarian analysis. The common belief is debt is bad, avoid. The deeper analysis, the reality, is what kind of debt, what is the maturity schedule, and are the underlying assets generating enough cash to service it? The expectation is that all energy service stocks are the same. The reality is that Transocean's focus on ultra-deepwater, harsh environment drilling separates it from competitors with less capable older fleets. This is not a stock for a basic SoFi robo-advisor. This is for an active investor who can track fleet utilization, day rate trends, and balance sheet maneuvers. It's about understanding that their $6.7 billion backlog is a more important number than the price of oil next week. Let's talk about the near-term outlook. The company reports earnings in about a week. This will be a major event. The expectation is already high after yesterday's spike. The market will want to hear confirmation of these high day rates, commentary on future contract negotiations, and, most importantly, a clear plan for debt reduction. If management delivers, you could see a further squeeze on the short sellers. If they stumble, or if the commentary on costs is negative, the air could come out of this rally just as quickly. That's the risk. This is not a safe investment like Fidelity mutual funds. This is high-stakes online investment. The trading volume and recent options activity suggest traders are placing big bets on both sides. People are using SoFi stocks and SoFi ETFs to get exposure to the energy sector, but RIG is a far more direct and volatile instrument. I want to hear from you. This stock clearly has people divided. Comment below. How many shares of Transocean do you currently hold? And are you buying after yesterday's news, or are you taking profits? Looking further out, the future of Transocean is entirely dependent on the duration of this upcycle. The expectation from the bears is that this is a temporary spike in demand, that as soon as oil prices waver, companies will stop drilling and RIG will be stranded with its debt. The reality, supported by the bulls, is that the world has underinvested in offshore oil exploration for a decade, and replenishing reserves is a non-negotiable multi-year process for the oil majors, regardless of short-term oil price swings. They believe we are in the early stages of a long-term structural bull market for these specific high-end assets. If that's true, Transocean isn't just surviving, it's positioned to be incredibly profitable. Its fleet is the key. While some investors are chasing speculative assets, this is a business with billions in tangible steel assets that are in high demand.